Russia-Ukraine tensions drag down Singapore markets and boost US stock futures. The Straits Times Index, STI, was down 0.76% to 3,374.7 as of 11:15 a.m. on Wednesday as tensions between Russia and Ukraine continued to escalate. As a result of the sanctions placed on Russia by Western powers, US equities futures gained while Asian stock markets were split. Shares rose somewhat in China and varied in Hong Kong, while Japan was closed for a vacation, according to Bloomberg. On Tuesday, the S&P 500 entered a correction after losing 10% from its January high. The demand for safe haven assets, such as the dollar and gold, has dwindled. Russia has begun to occupy Ukraine, according to US Vice President Joe Biden, who also vowed actions against Russia's elites and its overseas sales of sovereign debt. While these actions were taken, they fell short of the terrible consequences that had been warned. If Russia continues its hostility, Mr. Biden suggested, penalties might be increased. The yield curve flattened and treasuries dipped throughout the day on Wall Street as commodities rallied, highlighting the dangers of inflation. An almost three-year high was recorded in the three-year bond yield for Australia. Commodity prices have risen as a result of fears that the Ukraine stalemate might disrupt supply, from oil to wheat and nickel. A nuclear agreement between Iran and the world's major countries might bring back Iranian barrels, which kept crude oil constant. According to President Vladimir Putin, Russian troops have no plans to enter Ukraine. The upper chamber of the Russian parliament, however, has granted him the green light to send soldiers to separatist-held areas of Russia. The markets are already under stress due to the possibility of a stricter monetary policy by the Federal Reserve in order to combat inflation. A rise in raw material prices after the conflict in Ukraine pushed up expectations of Fed rate rises. According to Citigroup private bank chief investment strategist Stephen Whiting, the Russia conflict is possibly worsening a lingering supply shock. Whiting remarked on Bloomberg television, "When it comes to US markets and the global economy, the Federal Reserve's decision on how to deal with that specific situation is the most important factor."